All right, ladies and gentlemen, grab your seats. So we're going to have a very interesting panel. One of the, I think, the highlights of our conference every year is the panel on emerging trends. We have a great lineup here, and this starts off with our really top-notch moderator here, which is Professor Chris Brummer from the law school. We work very closely with the law school here in the business school, especially in areas of fintech, and have done a lot of work together lately. And you've got your fintech week coming up next week, don't you? Absolutely. So I'll stop here and remind everyone that we have this panel here, and afterward we're going to have the reception upstairs. But I'll come back and close the event at 5 o'clock. So without further ado, Chris, I'll turn it over to you to introduce your panel and go from here.
Okay. I am Chris Brummer, law professor over at Georgetown University Law Center. Thank you so much, John, and thank you to Rena for having me here. It's always a pleasure to coordinate and to cooperate with the business school on issues of financial technology and regulation. And we have just a wonderful panel. I was told to let everyone introduce themselves, so I'll just start, and then we'll launch into questions really touching on some of the more recent developments in crypto assets, the infrastructure supporting crypto assets and innovation, and then the regulatory responses. But I'll start off with you, Dan.
Hi, everyone. My name is Daniel Chavez. I'm general counsel for Emergent Technology, and thanks to Rena and Georgetown for inviting us to this panel. We are a fintech group. We do payment processing for digital companies in emerging markets, and more recently we've developed a permission blockchain to track the supply chain of gold from the mine mouth to the vault, and to create with that gold, which is conflict-free, responsibly sourced gold, digital tokens, which are digital certificates of title to that gold, and which can then be used as a stable digital currency.
Wonderful. Julie.
Hello, I'm Julie Winkler. I'm the Chief Commercial Officer of CME Group. We are the world's largest futures exchange. Probably know us from some of our key benchmarks. We trade Treasury futures, the E-mini S&P, gold, corn, been around for over 160 years. But what we will be talking about most today is one of the product launches that we got the most hype over in Bitcoin futures, which we launched in December.
Great.
I'm Daniel Gorfine. I'm Chief Innovation Officer and Director of Lab CFTC at the U.S. Commodity Futures Trading Commission. And I'm still trying to figure out how I want to navigate this couch and exactly what the right corner is, but getting there.
I'm David Jarczyk, partner with KPMG. I've been brought on to be one of the leaders of innovation for the firm. And what that means is basically working with our clients and helping them with their data technologies, analytical issues. Prior to that, for 20 years, I've been a small business entrepreneur. So this is quite a switch. So thanks for having me.
Great. I think then we'll just launch right into really one of the hottest areas of financial technology right now, which is the space of digital currencies, virtual currencies, initial coin offerings, and the like. And maybe you can provide a quick overview for those who are not familiar with the space as to some of the more recent developments that you've seen, and just provide your perspective on what ICOs, what digital currencies and tokens mean for the marketplace, both virtual and real.
Sure. So as most people know probably, ICOs, initial coin offerings, have become probably the most important fundraising tool for tech companies in the last couple of years or so, raising over, I don't know, $8 billion or so. And this initial coin offerings are digital tokens created by programmers, right, that initially were meant to have some utility, whether it was access to a specific network or maybe a pre-sale of services, et cetera. And they use those to offer them freely to the public and raise funds in that way. And obviously it was attractive because they were easy to create, because they were very easy to distribute, because when you don't ask the SEC,
things become easier.
Things become very easy with technology, right? You can make those available on your website, and in a matter of minutes, people can buy them, and all of a sudden you raise hundreds of millions of dollars. Because of the way they're structured and because of the way they've been offered, obviously they've been subject to increased scrutiny by the SEC and securities regulators all over the world, where they said, well, listen, whether your token has utility or not, they also have other features that make them look a lot like securities. And if so, then you shouldn't be offering them unless they're properly registered, et cetera. And so kind of the evolution from that has been, okay, well, people are kind of to realize that those tokens, for the most part, are securities. So they say, well, we'll now treat them as, we call them securities token, right? And then we'll offer them the same way. We'll treat them as securities. And now the challenge is, okay, how do we go about offering these tokens, which may have utility, but may also have other features of an investment contract that make them a security? How do we go about offering them? And then how do we handle the secondary trading of those tokens without losing all of the advantages that ICOs had, mainly access to a large investor base, and obviously the efficiency, right, and the speed at which you could trade those securities.
Yeah, that was excellent, actually. One of the challenges, and we'll get to this in just a minute, when you look at a token, is that the very term utility token is not a legal term. It's really a term of art. And yet it's really, from a business perspective, one of the major drivers behind ICOs, or at least mini ICOs, as a fundraising tool. And as a result, you get this collision of sorts between business people looking, obviously, to raise money for their ventures, but then certain legal realities in terms of what does a utility token mean from a legal perspective. And these challenges become more intensified when there are attempts to create some kind of secondary market and an institutional structure. So on the one hand, just as institutionalization can bring more potential liquidity for these ICO tokens, it also can present or push those tokens deeper or more obviously into the regulatory perimeter established by either securities authorities or by our derivatives authorities. Is there uncertainty in terms of how you gauge and examine and identify those products? And is there any level of, is that uncertainty a challenge from your perspective when you're trying to create the proper institutional environment for those financial products?
Yeah, I think there's definitely that uncertainty, right? There are some securities regulators and frameworks. The US is a good example where there is at least some test, right, to determine whether or not what you're offering is an investment contract and would fall into that category. Then you leave, so you leave the utility of the token aside and figure out whether it meets that test. And if it does, then chances are you are a security and then you have to follow the rules. The problem is that not all countries have similar frameworks, and not all of them have a clear definition or even a clear test to determine whether or not it is a security. So that leaves people with the option of say, okay, I could go ahead and offer them and see what happens and see if it gets subpoenaed from the securities regulator,
right.
Or go and ask the securities regulator to either give me an opinion or a no-action letter, or better yet, ask them to let me register my security token. And that's the ultimate problem, because even if you assume you're a security, even if you want to go ahead and do it kind of the right way, it's not possible in every jurisdiction. Most securities regulators will say, okay, yes, I think you're a security, but I'm not exactly sure how to register you. Right? I'm not exactly sure how to make you compliant, assuming you are a security. So they have to work on finding that, giving those alternatives, right, of saying, what's next?
And that's an excellent point as well, and I think it's really going to help us put into context some of our later conversations. But you're saying that even where you can identify a token as a security, the particular features of the financial product may be such that a regulator can have some challenges or face certain kinds of challenges applying, in this country it'd be the 33 and the 34 Act, sort of New Deal legislation to that financial product, because some of the, I would assume some of the intermediaries or some of the gatekeepers that are traditionally relied on may not be there at all, just because of the nature of the financial product.
Exactly.
And therefore you're left with a series of options from the second best to maybe the not so great.
Right. So when we see the first securities token registered with the SEC, for example, then we'll know. But we haven't seen it, right? And we probably won't see it for a while. And so the SEC is now going to receive all this requests and say, okay, you saying I'm a security, I want to be registered, right? And so they're going to have to figure out how to go about that. And then the exchanges, we heard it this morning from New York Stock Exchange and NASDAQ. Okay, now that we have securities tokens, which are securities, registered securities, how we go about listing them. And we heard this morning, like, I don't know, right? and we know they're out there, but we're not there yet.
So clearly, Julie, the CME has all the answers.
Don't have to deal with that. That's the answer.
You don't have to deal with that issue, which is really interesting, right? For those financial products, or certainly for Bitcoin in particular, there are fewer questions as to its status as a commodity or as a security. And it's very fascinating. I mean, there was much fanfare and interest, and perhaps in some segments fear, when there was an attempt to begin to institutionalize some kind of derivatives markets for Bitcoin. Can you maybe give us some context as to what was the thinking of the CME? What was the process by which you began to analyze, well, how do you create a futures market for Bitcoin? And then finally, sort of some perspective as to how it's been thus far.
Sure. Well, it definitely has been a process, and I think it really has been clearer for us and also CBOE that has a contract, because the CFTC looked at this years ago and declared that it was a commodity. So it was clear in the case of Bitcoin that it would be under the regulation of the CFTC and under the Commodity Exchange Act, and all of these questions that are very challenging for the ICO market right now and the SEC is just not something that we've had to navigate. But putting that aside, I think this has been probably one of the most interesting kind of contract new product evolutions that we have seen. Part of that is because this is just a very new and evolving space. And in any of that, there's a lot of things that you need to learn. And so we design contracts across every single asset class that exists. But in most of those cases, there's some type of tangible asset that you're looking at, right? You're looking at a kilobar of gold or barrels of crude oil. And for this, because of its very nature of being a virtual currency, it has a lot more challenges as we look to kind of design products around that. And so we'd looked at this space for a number of years. We had teams that were kind of evaluating it. And it really kind of got to the point where we said, probably while many of our contracts are physically delivered, meaning you can actually get 5,000 bushels of number 2 yellow corn or crude oil barrels, actually putting a Bitcoin into our ecosystem and into the infrastructure that supports the futures industry was probably not something that our firms or our clearinghouse were going to be comfortable with. And so we really started down that path of thinking then, another alternative is designing a financially settled contract. And what we felt was missing was a really, reliable, dependable reference rate that was out there. So we actually launched the reference rate on our Bitcoin reference rate back in November of 2017. And that was our first kind of public foray into the space of saying, hey, this is something we're looking at. And I'd say as a result of that, really kind of helped us dive that much deeper with our clients around their interest. Many of our clients had started trading pretty actively in the spot market. And one of the unique aspects of this market is that this underlying asset trades 24/7. And so designing any type of product-related derivatives contract around that was something that is going through the weekends, all night long, creates its own kind of unique aspects. But what our clients were telling us is that they really wanted an instrument, a listed futures contract in a regulated way that they could have forward price discovery. And it was using all the risk management practices that they are used to from, established exchange like ourselves. So We dove into it, had hundreds and hundreds of conversations with clients about what, the appropriate product size was, when they wanted this to trade, what other risk controls we could put around this contract to make it be as, safe as possible. One of the unique things we did on this contract is actually putting hard price limits in place on both the up and the downside, which we had not done in any other products. Because, again, there's a lot of volatility here. We wanted to make sure, firms felt that they had a good safety valve for big price moves. And we also allowed them to do things like credit controls, where they were actually able to go down to the client and turn off access to this particular product if there was a client that they did not want to have access to it. And so, we spent a long time working through all of that, spent a long time with our regulators as well of just making sure they understood how we were thinking about this product, talking about product design, talking about margins. And so it was really a very kind of deliberate, well thought out process of saying, we believe there is a risk management opportunity here that the marketplace needs. And, we launched it in mid-December. And from the first day that this product traded, we had activity in all 4 expirations of the contract, which is a pretty unusual thing to see that people are actually wanting to, again, to commit open positions and open interest going out every contract month that we had listed. So what that really kind of tells me is there was a true demand for having price discovery, and people really wanted to know what are people's expectation about what that Bitcoin dollar price might look like 4 months from now. And we've continued to see trading activity throughout all 4 expirations since we launched. We're trading about 5,000 contracts a day. That's an equivalent of 25,000 Bitcoin. So it's still very, very small on the scale, but for a new product, to be, almost a year in and see this type of activity, we're very pleased with the process that we've made. Certainly, there continues to be a very evolving global regulatory structure around all of this as well. And what we find ourselves spending a lot of time on is educating people about the marketplace and, taking that very seriously, because as much as the spot market has been a retail opportunity, it's really the institutional players that is who we are most trying to attract with our product, and really trying to educate them on how our product works, how the underlying markets works, and how they can get access to that. And so being kind of that trusted exchange in a heavily regulated environment is something that's pretty attractive for them to be able to get access to kind of that alpha that they otherwise can't get through the spot market.
Can I ask one rather technical, well, I don't know how technical it is, but it's an interesting question when you look at Bitcoin in particular. Lots of folks may say, well, given the time it takes to mine Bitcoin, there's a certain degree of latency. And that can pose certain kinds of challenges for investors, especially institutional investors. Do you get a sense that by creating futures contracts that are tradable in a regulated way, that there's oddly more liquidity in the derivatives world than there is in as to the underlying asset?
It's not all that uncommon. So, maybe the corollary in some regards would be, to look at anything that is a agricultural contract, right? I mean, you don't plant a seed and have corn immediately either. And you also see an outsized proportion of liquidity formation taking place in the futures market versus the cash markets, because every single co-op is, spread throughout, the United States and certainly a lot of other global growing regions. So what happens is that you need something that's a standard. You need that, kind of commodity standardization to occur. That becomes the price discovery point. And how quickly the actual underlying asset, creates itself or grows in the ground, or the barrels of oil that move around the world, is not as dependent as saying everybody agrees that this is the point that they can, and the place where they can express their opinions about the price of that. And then whatever their actual exposure is, then the basis risk that they're taking on.
Great. So Dan, you've had the pleasure of engaging the CME and other actors, not just as it pertains to Bitcoin and other virtual currencies, but really, I guess, really thinking about the innovation going on throughout derivatives markets. And you are now leading up those efforts over at the CFTC. And maybe you can introduce us to the concept of what do you do? And also, since you've been now at the helm of many of the innovation engagement efforts, you now have a little bit more information to provide us with how things have gone and what are perhaps your perspectives when it comes to cryptocurrencies, data, and other issues.
Sure. No, thanks. A good question and a lot to unpack. But actually, what we just heard from our first two speakers, I think, is precisely why we now have something like the Lab CFTC at our agency. And it's because we need to be keeping up and keeping pace with all these things that are happening in our market. So whether it's tokenizing assets, and that question on ICOs, which I think is a great question, it just reinforces, at least from what we've seen over the past year plus, that when you talk about ICOs and you talk about the tokenization movement, you can effectively tokenize anything. So you can tokenize any type of a contract. So whether we're talking about securities investments and investment contracts, or you're talking about tokenizing futures contracts or tokenizing oil and other types of physical assets, all of these things are in the realm of what we've been hearing about over the past year. And then certainly with the launch of Bitcoin futures at the end of last year, there has been a heavy focus at the agency on things related to crypto. But with that context, let me step back. I mean, obviously what all of this stands for is the ongoing digitization of our financial markets. And that's something that our chairman has been expressing now for many years, and our commission more broadly has recognized that capital markets tends to be a place where you see a lot of technological innovation having a real impact. So there was a view that we need to make sure that we have the right type of tools and understanding to keep pace with changes in our markets. So that's why last summer, it was the summer of 2017, the Lab CFTC initiative was launched. Our mission is to facilitate market-enhancing innovation, help to inform policy at the agency, and then make sure more broadly we have the technological and regulatory tools and understanding to keep pace. So what does that mean? We essentially have three primary work streams that we pursue to execute on that mission. And the first one, which is really the bread and butter of the initiative, is around engagement. Traditionally, the regulatory model, and Chris, you and I have thought a lot about this over the years, the regulatory model in the US has been largely enforcement driven, meaning that there's a perception that the only time you're going to hear from an agency is if it's the enforcement team calling you, and you probably don't want to take that call. So there's a view that we would be better suited, especially given the pace of innovation and how quickly new business models are developing. It would make sense to engage early in the development of new business models for both sides of the conversation. As a regulator, it allows us to actually hear what's taking place in the market, so we can see what's coming around the corner, be a lot more proactive in our thinking, and not scratch our heads 5 years from now and say, oh my God, the world is dramatically different. When did this happen? And really have a little sense of when that change took place. Those who are meeting with us, we hear a real range of issues and questions raised. Some innovators, and when we say innovators, we're talking about established financial institutions, registrants, technology companies, or true startups. When some of them come in and just want to have some kind of an explanation of the alphabet soup of regulators in DC. So they'll ask, well, why does the CFTC care about crypto, and how might your regulatory framework apply to our activities? If we can give that kind of high-level feedback, it can save a lot of folks a lot of time and resources. Others might come in and point out and say, well, there's ambiguity in your rules or friction in your rules that never contemplated the internet and things like virtual assets. So help us make sense. What are the right types of regulatory responses? A good example of us trying to engage in a dialogue with the broader market took place last year when we actually published our first primer on the topic of virtual currencies. And we did that in response to common questions we were getting from people asking us specifically how does the CFTC jurisdiction, how is it implicated in the virtual currency context? So that's the first prong of what we're doing. The second piece is, you could argue, a little bit more internally focused, but we're trying to think about how, once we identify promising technologies, should the agency think about either incorporating those technologies to make us more efficient and effective, or support the development of those types of technologies. So things we can do might be innovation competitions. The UK's Financial Conduct Authority has done a number of tech sprints around financial crimes and AML. So Lab CFTC put out earlier this year for public comment when we essentially tried to crowdsource ideas to do a similar type of innovation competition. You know, we're looking at things like robo rule books, machine readable or tagged rule books, so that compliance platforms and software can actually self-identify where particular activity may trigger certain regulatory requirements. That's a pretty interesting area. So anyway, so we were doing a lot under that second prong, which is what we call CFTC 2.0. And then the last element is really to make sure that we're internalizing what we're learning, share it with staff and the commission to make sure that we have a multiplier effect in terms of what we're actually learning in the market, as well as collaborate with other domestic and international regulators. So we work closely, especially when you talk about the crypto space. We work closely with our peers here in DC, including the SEC. And then on the international level, we're working closely with, we actually entered in earlier this year to fintech cooperation arrangements with the UK Financial Conduct Authority, and then recently with the Australians through ASIC and the Monetary Authority of Singapore. Where these were new agreements where we essentially are kind of reinforcing our interest in sharing best practices around fintech engagement. What works, what doesn't work, what can we learn from others' experiences, and what can we share in terms of how we're trying to develop what we hope is a replicable model. I mean, the idea of having this type of a stakeholder at a federal agency is one that we think is quite important.
Right. So Dan had mentioned things coming around the corner and engagement. Well, I'd like to engage with you, David, to get a sense of what are some of the new technologies that are coming around the corner and what kinds of issues, not just in the crypto space, but again, you know, when you think about digitalization, you're thinking about information that's being made more widely available. Literally, the proffering of that information is itself at times a more decentralized process, creating enormous questions of trust and validity. What are you seeing coming around the corner that you suspect may be having a real impact on financial markets and the work of regulators?
Yeah, so I'm very fortunate. I get to see the financial markets from a slightly different lens, where the financial markets tend to be early adopters, let's say, or early majority of new innovations. I work and support companies, and companies tend to be a little bit more risk averse, right? So when we look at technologies that perhaps traders or institutional bankers might use, algorithms, artificial intelligence, et cetera, these are considered somewhat foreign to certain companies, many companies which are traded on those exchanges. So let's look at this from a lens of a company and what's happening within the companies as they catch up as late adopters and laggers. Yes, Bitcoin is something that's interesting, although what we've found, it's the underlying technology of this distributed ledger technology, the distributed single source of trusted information that is really of interest to clients right now. So let me take a step back. What's a company's duty? What is it that it's trying to do, and why would it call a KPMG or anyone to help it out? Well, whether it's for regulators, whether it's for the markets, or whether it's for its stakeholders and shareholders, it wants to build trust and prove quality data. But then also for its shareholders and stakeholders, it wants to show that it's utilizing its data and its information in a way that generates value for those shareholders. Right now, what we're running into that kind of challenge that notion or those two goals of companies are companies have many disparate data sets. Picture a company that has grown by acquisition. One ERP system is now 25 ERP systems that don't speak to each other. We then have a problem of reconciliation of data. Companies can pull data out of ERP systems, but how do we put it back into the system so that all of the stakeholders of that data see what has been done with that data, get spreadsheets to talk to each other? Also, we then see the automation of what we would probably call, just in this room, the mundane, maybe simple, maybe boring tasks. You go back to Ford in the assembly line. Well, think about that when it comes to data. The folks who are hand entering data or reading through paperwork to enter that information probably could be doing higher value services for that firm to drive value versus doing that information. And then, of course, the holy grail, which I think goes into the financial markets, is using data to predict the future, right? Can we absolutely do that? So when we look at technology that companies are investing in, the first one's still a shocker to me as a small business owner, but it's true. Many companies are still working on getting their information in a single source on the cloud. So where we as human beings, right, as individuals, are on iPhones and Google environment, Android environment, utilizing Google Drive or whatever it may be, there's a lot of inherent risk in that situation. Putting your client's data, your firm's data on a cloud, whether it's IBM, Microsoft, or whomever, is risky. And it's new to these companies. And that alone sometimes takes deep bounds. But once they get that there, what they see is this technology that Bitcoin uses, blockchain. Blockchain is a heck of a simple and wonderful tool. It's allowing these different technologies, these ERP systems, to speak with each other. So what you have is untrusted parties that can speak to each other, perhaps a supplier to a company and the company itself, so that they can take a look and see what type of import taxes they maybe should be paying, or what type of regulations they might be privy to or falling under should a transaction take place. We're looking at what's now called semi-trusted parties. So within my own company, if I have 25 different spreadsheets, yeah, I trust my coworkers, but how do I trust that data? It's actually semi-trusted because someone adds one Excel row or changes one data field, everything could be wrong. And then finally, once we get our data onto the cloud, we get it into a single system that speaks to each other. Really the future, and really this is the future, is looking at things like artificial intelligence, cognitive, that will be making, at first, those regular routine transactions automated, allowing people to become subject matter experts. And dare I say, I mean, we're looking at a path here, I don't know if it's 3 years or 10 years, to be frank, but we're looking at a path where technology, in that framework that I just laid out, could semi-automate, and I say that again, semi-automate the processes within finance, accounting, tax, perhaps even legal. And all of that will then drive the confidence in the data that goes to the financial markets and trades are based on.
Chris, I just want to pick up on this. I think this is such an important area, and it's been a very common topic of things that we hear about through Lab CFTC, and that is, look, there are buzzwords out there. Everyone talks about cloud, and you hear DLT. Maybe better to think of it as DLT inspired. But I think that you're hitting it spot on, that what it all stands for is this notion that we're about to see kind of an upgrade of computing infrastructure. In many conversations that we've had with many, established financial institutions, they'll have these, for each division or office, they'll have these bespoke, scotch-taped and bubble-gummed databases that might work for that particular division, but they're not interoperable. They don't speak to each other even within one firm. Then you're trying to think about how do you move that data in an interoperable way amongst other participants or even in the way you're reporting to a regulator. And so what's fascinating on the DLT side is what Bitcoin, at its very least, what it did is it made talking about ledgers and interoperability, it made that a sexy thing for people to talk about. Yeah. And so now people are saying, well, wait a minute, yes, we maybe had this technology 20 years ago, but if you think about databases that can speak to each other, where you standardize data formats and fields and have multiple participants, that creates clean data. And that clean data can be housed in the cloud, which is very scalable. And then you start building analytics tools on top of it. So you start to see the potential for this vast upgrade of computing infrastructure. So I think it's a really interesting area.
Yeah, I think that's exactly right. And when we take a look at what companies, let's put companies aside for a second. Because companies report to regulators, which our clients do, we get to work with tax authorities, finance ministries, and a whole host of different offices around the world. And when we take a look at what's happening in the marketplace with regulators and those that support regulators, we were talking a little bit earlier, in Singapore, for example, they're allowing companies to utilize blockchain technology, not cryptocurrency, to file for software patents and artificial intelligence to speed up that process. Because what they're trying to do is drive innovation into Singapore. And if you can speed up a process for small businesses like where it takes $10,000 just to start to file a software patent, and if you can simplify that somehow and let people know who owns what technology, you've got a starting point for entrepreneurial businesses. We take a look at the Organization for Economic Cooperation and Development, which is a finance and tax policy group, headquartered in Paris, but they're global. They've come up with guidance. Now tax authorities actually share companies' tax return information. How do they do that? Via email? Junk drive? Excel? How are they doing that? Blockchain, single ledger, cloud, all of this would allow that to take place as well. And then let's take it one step further. Can you imagine if there was near real time, or at least close to quarterly reporting of taxes, of financial forms, et cetera, et cetera, et cetera, with the SEC, for example, with your organization, with whomever it may be, the tax authority. This is what we're looking at when regulators are looking at these technologies.
So there were about 18 million really, really cool and interesting, wonky, nerdy things that were generated in that dialogue. I want to
Just call us
pick-
nerds?
I know. That's right. Oh, geez. So I did want to say one of the more interesting issues, also just bringing it back also to our cryptocurrency conversation, involves developments in, one could call it a form of artificial intelligence in terms of smart contracts, right? And what does the development of a smart contract mean, particularly in a even sort of semi-trust environment where you may have to go off-chain in order to validate certain kinds of data inputs, and then how do you incorporate that process into your into your on-chain operations? And there's a lot of energy there. There are questions as to whether or not you should go to an oracle as a kind of a trusted source in order to generate a reference point, if one will, for information to then bring on-chain. But that then also creates all kinds of interesting legal questions as to how infrastructure providers are supposed to look at this, even when you create a contract. Julie, I'm not trying to put you on the point about this, but it is a really fascinating question. There must be, at some point, thoughts or considerations of other kinds of virtual currencies and building products for other kinds of virtual currencies, many of whom, I would suppose, may involve smart contracts. What kinds of considerations would one need to at least begin to think through in order to incorporate those kinds of features, or at least financial products that have those kinds of features, into the derivative space?
Well, at CME, we've looked at all of these things. Part of what the team did last year was a use case on smart contracts itself. I think the challenge and really kind of the opportunity around smart contracts, there has been so much done in the last few years around benchmarks and benchmark regulation. And for contracts, that are going to be financially settled, for the most part, or even physically settled, the fact that, that price is not readily susceptible to manipulation is a core principle of the Commodity Exchange Act. So whether that is a futures listed contract or it is a smart contract like infrastructure that sits, and that's the vehicle, I think it still comes back to, what's enforceable, what is behind that price that's being used. And that has been, again, I think the role and what regulators globally have stepped up significantly in the last few years is the rules around that. And so I don't think the vehicle itself matters as much as what we're doing to ensure that that's not being manipulated.
Great. Do you see any particular market opportunities and perspectives? Also from even, you'd mentioned earlier, the emerging markets context. I've, like probably everyone on the panel, when you travel widely, you see very different views, not just from a Singapore competitive advantage and we want, how much market share do we want in a highly developed environment, but also there are differences depending on where, in terms, a country lies in terms of their own economic development and a vision as to where they want to be. And that can shape how they approach the rule writing process for new and innovative technologies like cryptocurrencies. But where do you see opportunities? Where do you see differences perhaps in jurisdictions, not just amongst the regulators, but perhaps amongst the financial participants, market participants themselves?
Sure. Yeah, so I think that, again, smart contracts is, Dan was talking about the layers that you build on top of that information or data that you're getting through a blockchain, right?
Right.
You have the data now, the ledgers talk to each other, then you build on top of that those smart contracts, right? Which, if everyone doesn't know, they're neither smart nor contracts, right? They're just a rules-based action, right? If A, then B happens automatically. And so, but that
As a law professor, if I said that, I mean, people start turning things over.
So, but they have tremendous advantages, right? So think about countries where they're thinking about maybe putting all their property record on a blockchain. So as opposed to going through books and books and books and books with, where they keep track of the property records on the history of any piece of land for hundreds of years, right? Where everyone's having to write it by hand. If you manage to put all that on a blockchain, right, where it's now an immutable record, and you add on top of that smart contracts, rules that allow someone to say, I have now given you this, I've now mortgaged my property to you, and it happened automatically, and we didn't have to go through a 6-week process where we had other parties involved, where there was, obviously the possibility for human error, right? Or where at the same time, where I'd be able to say, I've now paid my mortgage, and now the mortgage is gone, like that, right? That creates a lot of opportunity for financial markets. That's an example where, again, some countries in emerging markets have said, well, it's time to move that way because nobody can trust our property records as they are right now. But you use the same principle for other contracts. As I said, we work on the blockchain for supply chain of gold. Mm-hmm. That's yet another industry that's probably 50 years behind everyone else, right? Where every transfer every time the gold changes hand, right? You're talking about papers and papers and papers and triplicate copies, right? And well, if you can automate all of that, right? If you can then allow someone to say, I've now sold you my gold, or I've now pledged my gold to you and received the proceeds for that, et cetera. So you can create, those smart contracts will get more and more and more and more complex. And as Julie said, the challenge there is, okay, how much are we going to trust those contracts? Right. How because we can't see them, right?
In essence, for every level of complexity, there's probably some kind of point at which you have to have an enormous amount of integrity in the system, and to the extent to which anything falls apart, it could end up.
Well, the amount of trust that you have to have, right? Just in blockchain in general, in Bitcoin, the trust that you have to think that that little line of code that appears in your wallet actually represents value, right? Well, the same thing happens with the smart contracts. If we execute a smart contract, who's to tell me that when I do A, B will happen as it should happen, right? So there has to be processes to audit those contracts to make sure that they are actually executed as they should.
Well, then you have to develop certain auditing standards, right? And then you have to also determine what kinds of third parties or sources meet those standards, and therefore you need to sort of create an entire regulatory backdrop just to get to where you're to what you're identifying.
Right.
In the interim, what do you think people should do?
People should give them a try, right? I think that's the way it's going to happen.
It will
right?
happen.
Where some industries are more open to making those type of bets, right? Again, I can speak about the gold industry because all the players, they kind of realize that they're lagging, right? And the process is inefficient, and they're willing to give it a try to make it more efficient. And just like that, again, in some cases, it's going to be countries, right, the governments that are going to be pushing that. So some of those countries where they're looking at, again, their property records or their IP records or trademark filings, they're the ones pushing it, right? So if the government of Singapore says it's okay, right, well, it's probably okay, at least in that jurisdiction, and more will follow, right, until we all tend to trust that, just like not all of us, but most of us trust the blockchain and trust that cryptocurrencies exist and have some value.
So Dan, I want to pick up on this conversation, also something that David had alluded to, but a little bit more explicitly, which is the question of cybersecurity, right? The degree of trust that one has is not just sort of counterparty risk and the like, but to what degree can you get bad guys who are looking to undermine your systems? How, to your knowledge, is the CFTC looking at this question of cybersecurity generically? And what, if any, place does Lab CFTC have in engaging with this particular issue?
Yeah, and so it's, this topic of cybersecurity is one that I think many people identify and say, gosh, this is really important. And you'll always see on a panel, everyone says, and we have to make sure we're thinking about cybersecurity. But there's a couple points to make there. Number one, I do think from like just a general technological literacy point here, whether it's leaders in business or in government or at regulators, it's really critical that people can go multiple layers deep in understanding what it really means to say that we care about cybersecurity, because this to me is one of the, it is a critical area of focus, because everything we're talking about right now, and smart contracts are the same way. When you talk about smart contracts, it's a technology that drives automation. It allows, back to this computing infrastructure point that I was making before, I can throw that in there as being part of what I think is driving, whether you're talking about cloud, whether you're talking about DLT or interoperable systems, smart contracts that can auto-execute. The point is, we're leveraging the internet, interconnected computers, you're leveraging that to drive potentially great efficiencies in all kinds of economic transactions. But what it also means is that the integrity of those platforms, and you're going to see larger kind of single platforms. Interoperability means you're connecting things, and that's good from an efficiency perspective. But from a cybersecurity perspective, it just means that the risks become even more paramount, or it's more critical to safeguard. So it is the question that I think people need to be thinking about and trying to answer from our perspective, in addition to, in general thinking about security, cybersecurity, certainly in the context when you get into Bitcoin-related products, to the extent that they're physically settled cryptocurrency-related products, that becomes a real issue around security of wallets and security of the actual crypto. So that's one emerging area that you need to be thinking about. But what we're doing is we have these FACA committees, and for those who don't speak Washington, these are by statute, you can create these advisory committees. We have one at the agency called the Technology Advisory Committee, which Lab CFTC helps to support. And through the TAC, as it's called, we've created a subcommittee on cybersecurity with a mandate to think about how emerging technologies may raise new questions around cybersecurity. So all the things that we're talking about, whether it's crypto, smart contracts, interoperable systems, whether you want to call them DLT-inspired or glorified databases, either way, or cloud, these are all areas that I think have to be one of the primary areas of focus in the immediate future.
And David, you had mentioned, you not only alluded to the cybersecurity, but you were really sort of moving in between that space of cybersecurity and then sort of the reg tech compliance issues. In your experience, how well integrated are those two? Because they can be sometimes distinct. What you're complying with can be very, very different. And you can be complying with lots of things, but it doesn't necessarily mean that you're going above and beyond or really getting into the details as to your own vulnerability in terms of your systems. What do you see in terms of the move towards cybersecurity? How serious are at least your clients and companies taking it as, at least from your vantage point?
Yeah, again, being very risk averse. Our clients, and again, that's just a general statement, but our clients really take security and data integrity very, very seriously. I think one thing that we're touching upon or skirting around still here is you could have all the databases, all the AI and all that, but bad data in, bad data out as well.
That's right.
Right? So now you have the issue of data integrity, cybersecurity, and we can keep really depressing each other when we start thinking about these things, right? So not only do our clients take this extremely seriously, not only because it's our data, the consumer's data or their client's data, but our firm takes it extremely seriously. So just the discussion about implementing a blockchain internally has significant risk hurdles that both our firm and our clients work together to either, sometimes they're insurmountable, sometimes they're surmountable. It just depends upon the profile of that company.
And Julie, to what degree, what specific cybersecurity issues arose that you felt that the CME had to think through when it came to the Bitcoin futures question? Were there any kinds of challenges that you thought were especially salient when it came to virtual currencies, or was it really just a question of making sure that your already established cybersecurity processes were up to snuff?
The big thing for us was just educating people that there were no changes to our processes, that the Bitcoins, this was a reference rate, this was a cash-settled contract, there were no Bitcoins coming into the clearinghouse, there were no Bitcoins going into our clearing firms. And surprisingly, even our clearing firms haven't had a lot of interest, even from end users, wanting to post Bitcoins as collateral. And so to just educate people of saying there is no, these are not being traded on the blockchain, there are no physical Bitcoins, behind any of this that is going through our infrastructure, it was a key part. But I think, and probably to Dan's point, I mean, your infrastructure, your processes, your approach to cybersecurity, it is a critical part of what we're doing at CME. We are a systemically important financial institution, and it is first and foremost in our minds. We invest millions of dollars in it because we spend a lot of time with our clients and our partners and our vendors, because we're all only as good as the weakest link within the chain and within the ecosystem. And that is, this was not part of the conversation 5 years ago. It is now part of every single board dialogue we have. I mean, that's the level of importance it has.
And it's changing the very meaning of saying weakest link in a chain.
Yeah,
Oh, well.
it is.
It's the end of the day. I had to try that.
It was funny.
I guess we're sort of beginning to get towards the very last minutes of the panel, but I did want to at least end it with sort of predictions. Not long-term predictions, short-term predictions. Where do you see in 2019 going through? Where do you see what do you see as either the biggest development in terms of fintech or fintech policy? And if possible, what do you see as really the greatest issue that needs some kind of policy response? Dan is exempted from the second question.
I think, just finish where we started on ICOs and STOs. I think that probably what we'll see next year or two is those tokens, those securities tokens, will start off being offered under private placement rules.
Right.
And then we're seeing alternative trading systems, right, that are going to be focusing on those type of tokens, which will give them some liquidity, again, still limited to accredited investors and so, but it will give them some liquidity, and it will be kind of the start of that secondary trading of compliant securities, right? And hopefully that will buy some time for the securities regulators and the exchanges to then kind of get more comfortable with the idea of actually bringing those into the securities, the registered securities board.
So from a policy standpoint, given that development, that move into the private placement world, really regulators, I assume you would say, would really need to think through how do you help to facilitate the safe environment, a safe trading environment for privately placed tokenized securities.
Exactly. Or how do we give them a road to becoming registered and being available to all investors?
Excellent.
I think from my perspective, I mean, the reality is we operate, and our financial markets operate in a very global and interconnected way. Unfortunately, what we're seeing in virtual currencies is it's very fragmented, it's very disconnected. You have some regulators that have, been, at the forefront of this, the CFTC being one of those, and educating themselves very early on about this space, and has allowed them to, develop things like, some additional guidance on virtual currencies and related derivative contracts. But I think it's hampering the overall development globally when there is just, it's difficult. The international coordination, there is no clear path. You have spot exchanges out there that are regulated by very different types of regulators, and not knowing how to, I'd say, navigate kind of that international, regulatory and policy space. And then you're going to see the advent of more, I'd say, SRO or self-regulatory organizations develop to try to give some credibility to this space that has been lacking, and to give more assurance that this is an actual asset class that will be evolving. Because right now that insuredness isn't there, and I think it is going to create the need for more policy development, but really that global coordination point, I think, is desperately missing, and is something that we're starting to see pockets of, but I would expect is something that's in the next year or two is going to develop quite significantly.
I will say that from our own plug, dcfintechweek.org, at the law school, we're teaming up with the IMF on a 2-day panel on crypto assets, and we'll have cameo appearances from Dan over at the law school, the IMF, and on Capitol Hill. But I agree, more
So
international
stay tuned,
coordination.
all the answers
So
next
stay,
week.
exactly, by the
All
end of
right,
next week, we'll have it all figured out.
So, it's kind of, it's nice as the Lab CFTC team can get together frequently, and we kind of brainstorm or guess what are we likely to start hearing more about. I see one of my colleagues up there, George Harada, who always has maybe the most out there ideas. But no, I mean, I think we talked a little bit about machine learning today, but one of the things that I think we're seeing is that there have been some real breakthroughs in the machine learning space. That's an area where, if you read Bostrom's book, it's like every decade people get excited again about AI, and then things don't live up to expectations. But there was the recent example of that famous chess algorithm that's been trained over 12 years on all of these different chess matches, and then in really short order, this new algorithm that's using a different approach to how you actually train the machine, it had been trained for 4 hours. And when they went head-to-head, the new 4-hour trained algorithm won something like 72 out of 100 head-to-head matches, with the other 28 being a draw. So that just tells you that there are some actual advances taking place in this machine learning space. So it's one of those that whenever it is that folks can start to make real breakthroughs, you're probably going to see a pretty dramatic impact in a range of economic activity, including in markets. So I'll throw that one out there.
Yeah, I actually completely agree with that. When we take a look at the new artificial intelligence, the intelligence, it's changing the way supply chains work. It's changing the way customer orders are made. It's changing the way, Amazon alone, it's in the public press, right? The way that they inventory their goods and predict what it is that I'm going to buy, even though somehow I don't buy anything and yet it shows up. So when we talk about those, it's the wife. When we talk about those things, we look at artificial intelligence as really being able to drive certain decisions, and within businesses that report to regulators that have compliance that they need to work with, a lot of that stuff could become automated. And what Dan said is actually very exciting, and I didn't know that until we got here on this panel, but I think to the extent, to your point, internationally, if we could, this is not a prediction, this is a hope. I'm a Chicago Bears fan, so I hope. Even though I tell you they'll win, I hope.
This is the year.
This is the year. But if we could see more coordination in those, not only, as I said, with the OECD and the ministries of finance and tax authorities, but really beyond that with the SEC and their equivalents across the globes, seeing that in a way that looks at innovation and this technology and says, how are we going to adapt to it and adopt it, both adapt and adopt. That would be a real nice prediction to come true.
Well, I guess we'll end this excellent panel on a positive note of hope. And I'll just, I guess, hand it off to John.
No, I love the positive. I'm a Redskins fan. I'm saying same hope. So anyway, thank you guys. Let's have a round for the panel. This concludes the Financial Markets Quality Conference in 2018. Jessica's worked her magic, and she's moved the bar to right outside the door, so nobody has to even go to the 4th floor. So please, a lot of our panelists will be sticking around, and will be a lot of people. So we want to thank you again for coming. We welcome your feedback on things you'd like to see for next year. As Chris mentioned, there's FinTech Week next week at the law school, which is really exciting. And as I said, we continue to push, tech, fintech, blockchain, et cetera, across Georgetown and every discipline that we have. And I invite all of you to join us for a quick reception upstairs. Thank you very much.